stockmarketHQ's market update for June 13th, 2022. This week's market update focused on market sentiment and the difference between prices that investors are willing to pay, where there is free money, and the actual value of the company itself, and the effect that monetary policy has on stock prices. So we're going to do something a little bit different today. We already know that the market's in a downtrend. So we're going to look at a whole lot of portfolio stocks as well as the current market condition. So starting off with the fear and greed index, as we can see, it's at 17, which is into the extreme fear level. So that's a reflection on the actual stock market sentiment itself. Moving on to the volatility index, or the fear gauge, we can see that the volatility index is near its previous current near its previous peaks, uh, which is up around that 36 level there. So it's definitely got room to go higher. As we look at the MACD momentum indicator as well, it definitely has room to go higher as well. But what's kind of interesting to note is that even though that the volatility index is up at these previous peaks, the momentum is not as high as it was in at other times there was peaks. So that means either one of two things. Either this current peak is kind of a false peak, or alternatively, there's a lot more room to go upside there where this volatility breaks out to the upside towards the kind of 45, maybe even the 50 mark. So it's really something that we want to keep an eye on. We do have a catalyst within the next 2 days. The US Fed Reserve on Wednesday will announce its rate hike, which is expected to be 0.5% increase, as well as providing your commentary on the economy. The kind of issue with that is that they're really lacking a lot of credibility because they appear in the marketplace to have been misreading the economic conditions. So there's a lot of mistrust amongst big financial institutions as to whether or not they're actually navigating the current market environment correctly. That's where the fear over the last kind of 4 or 5 months has come from. Next, we want to take a look at the NASDAQ McClellan oscillator, whether the market is into the bought or sold or over in the buy zone or the sell zone. So this is midday on June 13th, so the final readings for the day hadn't come in, but we were down at this 15 mark here, so definitely had quite a ways to go. We spent the last few days in the sell zone, so it would have been the time to do some selling, and now we're getting down into that buy zone. We want to look at for those extreme kind of levels are totally possible in that 70 to 80 kind of range where we've had before. And if we look at the kind of momentum indicator, it's definitely turning down and it's got a long ways to go as well. So one of those things that we want to keep an eye on as well. And we're going to tie this next into the Standard & P 500 index. Because what's important to know is that even though we're getting into that oversold condition on the NASDAQ McClellan oscillator, if we have a look at the money flow index, the money flow index really hasn't come down yet. And it's definitely nowhere near at the oversold level at 20. It's currently at 51, which is still at the elevated levels near where it was at previous kind of peaks over the last 4 or 5 months. And if we look at the MACD momentum indicator, we've got that black line crossing below the red line, which is generally a sell signal. What's interesting here, though, is that even though the prices are dropping, when we look at the on-balance volume, we see a base level of institutional ownership, and we're not seeing big institutions start to sell yet. So if the big institutions do start to sell, and that's going to be reflected by a decrease below that support line, and that's going to cause stock prices to really drop. Now, what we're seeing in the marketplace at the moment is over the last kind of few months, we've seen this downtrend, which is very clearly we're in a bear market here. However, we did have this really nice bounce off this low here. And a lot of people are labeling this as a bear market rally, which certainly it could be. However, what that rally is followed by is what appears to be a short selling strategy where short sellers come in and they're able to dump shares on the open market each morning, gap the price down below the previous day's close for 3 subsequent days there. And that's a very classic short selling strategy because investors are basically locked into taking a loss and forced to sell at a loss, which then drives further selling as stop loss orders are hit, and then margin call requirements from anybody who's borrowed money are forces people to sell to cover their margin calls when the banks want their money back. So that's a very typical pattern that we see there. This is not, as we can see, this stock price is not a result. This stock price decline here does not correspond with actual institutional selling, and it doesn't correspond with money flow flowing out of the market. So certainly money flow can come out of the market, institutions can start selling, and that would cause prices to really collapse down. But at the moment, we're just going to be we just want to be aware that there is a catalyst ahead. Short sellers are executing on a strategy, and it's not until after that catalyst occurs on Wednesday, June 15th, that we're actually going to see the actual market reaction to that US Federal Reserve policy. So we want to take a look at this stock market position in the context of all the other stocks because the S&P 500 is an index made up of a whole lot of other stocks. So we want to look at the other stocks to see what has to happen in order for the S&P 500 index to continue down or to effectively collapse. So the first stock we're going to take a look at is Apple because Apple is really the largest cap stock in the exchange at over a valuation of over $2 trillion. So again, when we look at the money flow index of Apple, we're not seeing money flow out. It's not it's not an overbought level. It's at 70, so it is getting close to that overbought level, but it's definitely not at the oversold level. When we look at the MACD momentum indicator, the black line crossing below the red line is generally a sell signal, as well as the money flow index getting up towards that 80 mark is also a sell signal. When we look at the on balance volume, we can see on the on balance volume that again, there's been no institutional selling. There's just a really channel that's of a channel of like or a base of institutional ownership there. What we really want to be concerned, however, is if that breaks down and institutions start selling, then we're going to see the prices start to collapse. Ideally, what we want to see is for the market to go up, for Apple to go up, is for institutions to start buying. So when price breaks, when institutions start buying, that's going to be the signal that the stock price is going to change direction. And with Apple, what we had over the last few days again was very classic short selling strategies, with prices being dumped. They were able to do this because last week was the Apple Worldwide Developers Conference, which was a catalyst. And once the catalyst is over, well, the trade is over. So when there's no positive catalyst, short sellers are able to trade against that. And as we can see here, the stock price is right down at this technical support level of $132-ish. So if Apple breaks below that, then it could drop down to $128, possibly even, if we were to put that in the context of this money flow index, by the time that this money flow index got down to the 20 level, that would probably correspond with an Apple stock price somewhere around $120 to $122, which would also correspond with the MACD kind of matching up with this previous bottom at the middle of May. So that's the downside risk, and of course the upside. What we're looking at the upside after the uh, Federal Reserve meeting rate hike announcement is hopefully return back to these previously prices of around $140 initially, then up to $150. But once again, that's going to be totally reflected in the institutions buying or selling the shares. So Apple's the most important stock in the market because generally as Apple goes, the rest of the market goes as well. We also want to point out that the best time to buy Apple is almost consistently always in the middle of June. However, there is a concern which is overhanging the stock, and that is the uh, effect of supply chain issues coming out of China. In the last quarterly conference call, Apple very clearly stated that if the COVID lockdown in China lasted beyond the middle of May, that would affect their supply chain. Well, China's just come out of their COVID lockdown or easing their COVID lockdown. So that is actually going to be an overhang until we do have some kind of indication from Apple of what their supply chain issues are, and that's not going to be until they report earnings in July 27th to the 30th, somewhere in there. So that is going to be an overhang to the stock until we do get that information. Next, we want to take a look at Facebook, and we're going to see this very same theme here throughout almost all of these stocks. First, we want to take a look at the base level of institutional ownership here. Again, it's trading in a channel, and we're looking for that institutions either start buying or start selling, but so far we're not seeing either. It's just uncertainty right there. Next, we want to take a look at the money flow index. The money flow index is at a level where it's had a consistent failure before in the past and had price reversals over the last 4 months there. And as well, we want to take a look at our MACD, and the MACD, the black line crossing below the red line. It's kind of the first indication of a sell signal, but it's not a very strong one at the moment. We'll also take a look at our price, and the price is right at that technical support level, somewhere around $178. What I want to really point out here is on these charts is that on the side here, all these black lines, horizontal lines, they show the number of shares that have been bought at various price levels. So when we look at here, these are all the people, this black line here is the volume of shares that were bought between $195 and $180. It shows the number of shares that were bought between $205 and $190-ish. And what's important and significant about that is that anybody that comes in and is selling right now at this price of $168, those people are all people that bought up higher, which means that they're all selling at a loss right now. There's only so many people that are going to sell at a loss before they actually start to go, hey, we're just going to hold on to this and see what happens, because the short sellers have power as long as there are people that are selling from fear. Once those sellers dry up, then the short sellers have to cover their shorts and start buying the shares back. So that's what we really want to keep an eye on here. And this is what we're looking at in terms of a very strong technical support in this zone, as well as the number of people that are currently holding at a loss and might not want to be losing. The institutional ownership also provides some support. The kind of downside here is that Facebook has downside to the money flow index. Next, we want to take a look at Microsoft. Again, very similar theme here. Base level of institutional ownership. We've got money flow index is not being sold off. It's not declining, but we do have the MACD momentum indicator is turning down. And again, we've got this pattern here that looks like very clear short selling. We had very strong support here around this $270 mark. There's a breakdown below $270, which went down to $260, and then there was a subsequent reversal with price move up there. A lot of people call that a bear market rally. That's generally what we would call it, with the exception that now we've got what appears to be short selling. we're not going to know that until the U.S. Fed reports their interest rates and we get the reaction to that. Next, we want to take a look at NVIDIA. Again, same theme. Base level of institutional ownership. Not seeing the big institutions selling yet. We've got the MACD momentum indicator. As black line is about to cross the red line, which is generally a sell signal. But when we look at the money flow index has been in an uptrend. What we don't want to see is we don't want to see that money flow start to flow out of the stock and fall down below that uptrend line. However, it is also at a level where the prices have reversed in the past. We could also look at the technical support level right at this $158 level. That's been touched 3 times. So you've got this downtrend line, and then we had a reversal, and again we've got the same concept, which is just being repeated throughout all of these tech stocks, or all the stocks in general, which is 3 days of short selling, leading right up into a catalyst of the US Federal Reserve meeting. So as we look at all these stocks here, they're for the market, for the S&P 500 to decline further, these large cap tech stocks, we've looked at 4 of them now, which actually make up for about 12% of the S&P 500 index value. For the whole index to go down farther, there's going to have to be a break in support, a decrease in money flow, and institutions selling out of the stocks. Next, we want to take a look at Boeing. So we're going to take a look at a little bit more of the transportation sector here. We've just had a look at the technology sector, just to see if there's any difference in there. Now, with Boeing, what we had, it's just been a mess of a stock. But in general, Boeing is a company that, in theory, this stock should be working. It's a defense company during a war. They offer aircraft which are 20% more fuel efficient than a previous generation of aircraft during record high oil prices. And fuel is the largest cost expense to airlines. And as well, we're coming right up into the summer travel season. So Boeing traditionally would be a stock that would be working. Unfortunately, their management does not have a lot of credibility with either institutions or the various government regulators around the world. So that's going to be an overhang of the stock. Let's just look at the technical patterns here. So we previously had a base level of institutional ownership. There was a breakdown from that level, and we currently have another base level of institutional ownership here as well. And we're either going to see this institutional ownership, institutions start to sell this stock, or they're going to start to buy this stock. That's going to be what determines the price. And it's not until the institutions start buying back into this and seeing some potential in the next 3 to 6 months that the stock price is going to start to recover. Going into the money flow index, I'm going to change the color here because we want this to be a little bit more representative of what's going on. So the money flow index is up at a level of 55, and we've seen money flowing into the stock, which is reflective of the price reversal going from previously $116 low up to $142 low. It looked like it was about to break out here and recover towards the upside, but it didn't. So money's been flowing into the stock. And as we can see over these last 3 days, even though the stock price has completely collapsed, well, money flow hasn't actually flowed out of the stock yet. Same pattern. That reflects short selling in an unrelated or uncorrelated industry, with airlines have nothing to do with iPhones. But we do also have the MACD momentum indicator, which the black line is about to cross below the red line. That's generally a sell signal. Now, on the positive side to this one, what we have is called a 5-leg Elliott wave pattern. And what happens is leg 1 goes down, leg 2 is a retracement, leg 3 is downward, leg 4 goes up, leg 5 comes down, and then after leg 5, there's supposed to be a reversal, which is what we got. However, that reversal was met with short selling. So that's where the stock price is at currently. Again, industrial sector separate from, sorry, an industrial stock, which is also transport stock. So we're going to look at, so we've thought that maybe this was specific to Boeing in particular, but we also want to take a look at Airbus, which is the other manufacturer in the duopoly. So again, we've got a different pattern with Airbus. With Airbus money flow index, we have money flowing out of the stock. That's the opposite to Boeing, which is currently towards its high. We've got the MACD indicator, momentum indicator. The black line is crossed below the red line, which is generally a sell signal. We've got similar base level of institution ownership, and we're not seeing that institution selling below that line yet. But what's interesting here is we've got price in this trading channel, and price is up around that $30 mark. And again, we've got that sell-off about 18% over 4 trading sessions. Well, that's a really big collapse, and that tells us that the price concerns that we have with Boeing are not specific to Boeing. They also affect Airbus. And that's one of the reasons why we're still staying with the stock, is because when we look at Boeing at $115 and we talk about the premium that investors are willing to pay for the stock versus the actual book value or value of the company at $115 for Boeing, that was last seen during the March 2020 start of the COVID pandemic, where airlines were grounded, no airlines were flying, no airplanes were flying, and Boeing had its 737 MAX crisis where it wasn't able to even manufacture any aircraft at all, or sell or deliver any aircraft. So we're right down to the value of that company is at those lows there, which from our perspective makes the company very cheap, both on a technical perspective and on a value perspective. But going back to Airbus, so again, Airbus is right down at that technical support level of $25. Next, you want to look at airlines. Again, in the transportation sector, we've got United Airlines. Same thing, base level of institutional ownership. The institutions have not been selling this stock, but we've got this stock price has just collapsed in the last 4 trading days. United Airlines has been in this really nice trading range between $50 and kind of $41 for the last 6 months. And we finally just had a breakdown below that range on no news whatsoever. Yet we are currently entering the peak travel season. Airlines are saying that they're getting pricing power that's between 10 and 20% stronger than pre-COVID levels in 2019. The traffic levels are nearing pre-pandemic levels. They're at pre-pandemic levels domestically, and they are increasing in internationally. And the U.S. has just announced that they are lifting COVID-19 testing restrictions. That should have been a catalyst for airlines. However, as we can see, the price broke down out of that long-term trading channel. So this actually looks like it's going to be a buying opportunity, because 1 week from now or 3 weeks from now, we're still going to be in that situation where travel market is increasing, the pricing power of airlines is increasing. The one negative on this is the high cost of fuel. High cost of fuel for the airlines, well, you'd think that they would want to replace their aging fleets and accelerate deliveries of Boeing aircraft. Looking at the money flow index, we can see that the money flow index is not showing a getting into an oversold condition, even though the stock price has crashed. The MACD momentum indicator, black line, is crossed below the red line there, and that's definitely in a downtrend. And when we look at uh, the amount of shareholders that have bought, well, the bulk of the shareholders have all bought above this 40, in the last 6 months have all bought above $40. So anybody who's selling now is selling at a loss below $40. So in order for United Airlines to contribute to the market going lower, well, there's a lot of people that are going to have to sell at a loss. Next, I want to take a look at UPS, and this is a little bit more in the logistics department, air logistics department. So again, similar theme, base level institution ownership. Institutions have not been selling this stock, even though the stock price has been going down, which tells us that there's stock price going down is not a result of increasing supply by institutions. We've got the money flow index is not anywhere near an oversold level. And in fact, it's been in an uptrend. The MACD momentum indicator is definitely turning down. It's got lots of room to the downside. But the price is right at this technical support level. And even at UPS, when we look at where the bulk of the shareholders are, again, anybody that's selling down below this $167 mark is selling at a loss because they bought between $170 and $189. So again, the downside risk to this, of course, is that the money flow has a lot of room to the downside before it actually gets to that oversold level. Stock price can break through this technical support level and institutions can start selling, but they will be selling at a loss. Union Pacific, rail transportation. So again, same theme, base level institutional ownership, money flow index going upwards in an uptrend, not in a downtrend, not in an oversold condition, even though the stock price has gone down. The momentum indicator, the black line crossing below the red line, again, the sell signal. And this rail transportation has been in a downtrend, likely because of the freight logistics coming from China, maybe not having enough product to move on the trains. However, that is a stock that should be working as well because there is high freight rates and because there is no shipping or limited shipping availability. Well, that should be translated into ground transport or air transport. But again, we've got railroads completely uncorrelated to airlines, which are completely uncorrelated to people visiting their friends on Facebook and viewing advertisements. So in order for the market to go down, S&P 500 to go down, there would have to be a lot more institutional selling in Union Pacific and a lot more money flowing out, and the stock price would have to break down even more considerably. Next, we want to take a look at financials. Now, financials are something that should be working in this market as interest rates go higher because interest rates generally mean more profitability for banks. The kind of flip side of that is that it also results in kind of reduction in mortgages, creates some demand destruction with that. But let's take a look at the stocks. So financials for the last 5 months pretty much have just been in this downtrend where institutions have been selling shares, but right at the end or middle of May, we've had this reversal here where institutions started buying shares. Look at the money flow index. Money flow index is showing money not flowing out of the stock, and it's at a mid-level up in that kind of 60 mark. That shows that there's lots more room to the downside. But if there was a collapse in that money flow, then that would result in the stock really breaking down almost to 2020 levels again. MACD momentum indicator, again, black line crossing below the red line, that's a sell signal. What we've got here on the price is we've got this descending wedge pattern, and generally a descending wedge pattern results with a recovery and a breakout. So in theory, this should have been a breakout. It was. That's what we were expecting out of that pattern. However, we end up with, again, short selling, a pullback on short selling. And when we look at the actual price itself, we're down at $116 a share, which is a technical support level. So in order for something like JP Morgan or financial to contribute to the stock market going down, there would have to be a breakdown in financials. Again, financials have nothing to do with freight logistics, airplane manufacturing, or NVIDIA's chip processors and the transition of the digital age. I'll look at another financial institution, Goldman Sachs. Goldman Sachs is a company that should be working. They know how to make money in volatile markets, and this is a volatile market. But again, same pattern. We've got a base level of institutional ownership. Institutions are not selling and institutions are not buying. We need to see institutions buy or sell in order for the stock price to change significantly. Money flow index, again, right at that mid level. It's not going down, but by the same token, it is at the level where it has had previous resistance. MACD momentum indicator, black line crossing below the red line is a sell signal. Again, same as JP Morgan, we've got that downward descending wedge with a breakout followed by short selling. And now we've actually broke well below the technical support line. But when we look at people that have all the institutions or the traders or the buyers of shares over the past 6 months, they're all been between $300 and $330. So anybody that's selling down around this $285, there's nobody that's bought in the last 6 months at this level. So anybody that sells around this in this current zone here is selling at a loss. All right, so we want to take a look at so we've looked at a lot of the significant sectors in the S&P 500. We want to take a look at a couple of stocks outside of the S&P 500. We want to take a look at the effect that the concept of free money turning to cheap money, which turns into expensive money, and what happens with expensive money as it relates to the speculative market. So we're going to take a look first at DraftKings, and when we look at DraftKings, you can see the stock price was actually upwards of $60, and now it has come down right to this $11 mark here. And it's just been a downtrend ever since the US Federal Reserve started talking about tightening interest rates. And that's what happens with speculative stocks and interest rates as free money turns into cheap money, which turns into expensive money. They can no longer borrow money at low interest rates to fund their operations, and they are completely dependent on their actual ability to generate revenue and generate profit in order to grow their operations. That's why speculative stocks always come down when there are in a rising interest rate environment. As far as where can this go, DraftKings was previously one of the meme stock favorites there. But when we look at, put this into context, it sounds really cheap and really great. But when you look at a company that's valued at $11 a share, in order for that to get back up to $30 a share, that stock has to go up by 300%. Well, that's just not going to happen. So the only way that would happen is if there's a lot of free money that came back into the market. Next, we want to take a look at Bitcoin. Again, Bitcoin is an interesting phenomenon because it was widely hailed as the future safe haven of currency, which was going to replace gold, where the US dollar is generally the benchmark for currency. Whenever there's a recession, gold starts to increase in price. as a hedge against inflation, and Bitcoin was supposed to be the replacement for gold. What we can see is Bitcoin has just had this collapse from previously upwards of $60,000 to $48,000 down to $30,000. And then it's just collapsed 15% in one day down to $23,000. So this is an extremely volatile asset, something that you generally don't want to touch because there is no actual financial backing to Bitcoin versus something like the US dollar, where the US dollar is backed by the creditworthiness of the country and the ability to collect taxes and support its own currency. With Bitcoin, there's just absolutely nothing there. And that's why this Bitcoin is so incredibly volatile. And that's a very significant breakdown. And what this tells me is as we are watching interest rates going up, this is telling me that Bitcoin was kind of falsely inflated. It appears that somebody in Bitcoin was taking free money, pumping it into Bitcoin, and now that they're going to have to pay higher prices there for interest on that borrowed money, now they're forced to take that out, and the Bitcoin is basically kind of collapsing. That might be short term, maybe it comes back, we don't know, but on its surface, that's what it looks like. Next, we want to take a look at seeing where all this money that's been coming out of all these stocks over these last 6 months has been going. Now, the stock market big money managers always come up with themes. In 2020, it was the stay-at-home theme. In 2021, it was the reopening trade theme. And in 2022, it's the sanctions theme. So anything that has to do with sanctions that the US is imposing on Russia is going higher, which is the oils and the commodities. So we take a look at the oil stocks. Now, this is really interesting because, again, we have a base level of institutional ownership, but over these last 3 months, there's been actually no institutional accumulation of those shares, even though the price has been rising. All of the price accumulation happened back in March, and that was the really high rise initially. And we can also see that in the institutional ownership itself, where institutions started buying shares of Chevron, which also happened to correspond with Warren Buffett making his initial investment in Chevron as well. But then institutions didn't continue to accumulate shares, even though prices built up from that kind of $150 level up to $180 level. So what we want to look at is the steepness of the price increase here from that $150 to up towards 182 was the peak. Meanwhile, there's no share accumulation. And when we look at the money flow index, we can see the money flow has actually had a series of lower highs. That tells us that investors or big money managers are not putting more money into the stock. They're actually taking money out of the oil business or Chevron as prices go higher. We can again see that with a declining momentum as well. So you've got a declining momentum as oil prices have been climbing. But oil prices have been climbing as money has been coming out of other stocks as well. So that's where the money has been going. Now, the big oil companies like Chevron, when we take a look at oil itself, well, if oil prices were going to be remaining high and the big oil companies thought they were going to remain high, they would start to increase drilling. And increased drilling would directly affect the oil service providers, and the best one in the world is Schlumberger for that. And when we take a look at Schlumberger, it's had this really nice accumulation of shares. over the last 4 months, but the price did not reflect any change. In fact, it was actually really late to the oil party, with their prices not increasing until May 10th versus Chevron's, which started right in March. So it's almost 2.5 months too late to the oil party, which kind of tells us that what happens generally is that investors, big money managers, will move into uh, the kind of primary shares in a sector. And then once they feel that those are fully valued, then they'll look for secondary stocks that haven't moved, and then they'll move, and then they'll start to buy into that. So we've seen this nice move there, but again, we take a look, and even oil under the sanctions themed trade has been subject to this market sell-off as well. So there's no safe havens here at all. The MACD momentum indicator, again, the black line crossing below the red line is a sell signal. And something like Schlumberger could drop right down to this $42 to $38 mark. And the money flow index is not yet oversold. So that's where the market sits. So in order for the S&P 500 to drop even more, we're going to see a lot of stocks that have been in declines, such as Apple, Meta, Microsoft, any of the tech companies, the Boeing, United, logistics companies, financials. Those would all have to decrease. And the oil stocks would also have to decrease at a time when sanctions are still being imposed on Russia, and Chinese demand is probably going to be increasing. So overall, not a very healthy market. There is a catalyst on June 3rd or June 15th, the U.S. Federal Reserve. That's largely going to dominate the market direction, and that's going to be a better idea of where the market's going to head from there. It's anybody's guess. Thank you very much for listening. We hope that was informative, helps you with some of the investment decisions there, and hopefully it was educational. Thank you.